Hello, everyone. Welcome back to Financial News. I'm Ron Jankowski with Channel 4, and my co-host is Paul Munico from Ameriprise Financial. Today is March 14th, 2022. And Paul, you have lots of information to share, last-minute updates, and when you're finished with your report, I'm going to give you what Ameriprise had shared with us for this morning's news.
Sounds great. Today I am going to give you the current adjustments we are planning given the economic conditions. Number one, higher inflation is going to shave our GDP forecast. So at Ameriprise, we're lowering our 2022 real gross GDP forecast to 2.8% from a prior 3.5% due to the recent jump in commodity prices and resulting inflation impacts. We do expect inflation to run higher and for longer than our prior forecast, primarily due to the resulting uplift to food and energy costs as a result of Russia's invasion of the Ukraine. We now look for PCE inflation this year to be almost 0.8 of a percent point higher than our prior estimate, which is a direct subtraction from our full year GDP estimate. Growth in Europe, most recently forecast a 3.9% for 2022 by the IMF. That was released back in January. It's likely to show a more pronounced slowdown, yet remains soundly in positive territory in our view. And then the question we get is, what does our reduced outlook suggest for financial markets? The answer to that is the war in Ukraine is the driving force behind our negative adjustment to real GDP outlook. The situation, now just about 2 weeks old, could yet offer either negative or positive implications for economic growth depending on its evolution. However, the situation is likely to slow the Federal Reserve's pace of interest rate hikes this year relative to the prior landscape. The uncertainty of the situation should also naturally favor capital inflows to bonds, thus keeping interest rates relatively in check compared to the previous non-war landscape. Then as for stocks, a primary consideration will be the influence on corporate earnings, i.e., can corporate earnings still grow at their currently projected rate of about 7% this year under the slower growth scenario? Individual sectors should be expected to see material adjustments. However, we believe 7% earnings growth is still possible. Inflation could act to boost nominal sales and earnings more than any loss of demand due to higher prices on the margin, compressing pressure of higher input costs. That's just in our view. Now, in the 5 years pre-pandemic, 2015 through 2019, U.S. real GDP grew at an average rate of positive 2.4%, while S&P 500 earnings per share expanded at an annual average pace of 7%. And we've got, again, data and bullet points to reflect this should you want more information on this topic. But nothing earth-shaking there, Ron. Inflation is up. Uncertainty, as we talked about every week in the past 2 weeks, is high. And the markets don't know where to go in situations like that.
In this morning's news that Ameriprise had shared with us, the U.S. stock index futures indicated a modestly higher open amid reports of progress in talks between Russia and Ukraine. So there you are. What is going to happen?
Anytime we get talks, the market wants to like it, but I think our hearts and minds are telling us this thing isn't over yet. But
exactly.
We got to wait and see.
The big word, uncertainty. Where's
Right.
it going? Who knows? Markets in Europe are trading higher at midday, and stocks in Asia closed mixed due to the weakness in China. And Shenzhen is on lockdown due to the country's zero COVID policy. So
Yeah, I read something on that over the weekend. I guess there's another outbreak there. I don't know.
Yep. Who knows where this is going to lead? And the other two items, the U.S. Treasury yields are climbing with the 10-year over 2%, and WTI crude is falling to about $104 a barrel. That's a good sign because it was up as high as, what, 120 a barrel?
Oh, I think it came close to 130. I'm not
Okay.
positive, but it was up there. I mean, that's still high, but
Yeah. At least it came
at least
down.
it came down a little bit. You're right.
Which hopefully will give us some relief at the pump. We'll see what happens. And the FMOC meets this week with expectations of the first rate hike since December 2018. We'll see what that's going to bring to us as far as interest rates are concerned.
Yeah, I mean, that's the big, again, uncertainty is, we kind of expect rates to go up this week, but we don't know how much. Is it going to be a quarter point, a half point, and will it not go up? Again, uncertainty causes fear, and fear does not bode well for the market.
Well, the year-to-date index returns for the S&P 500 are minus 11%, Dow Jones a minus 8%, and NASDAQ a minus 17%. You expect that with what we're going through.
Yep, I think a little worse than what we reported last week, so the markets were down again, but not horrible, horrible numbers given the rallies we've had the last couple of years, but certainly not where we want to be.
Exactly. Okay, well, thank you for that report, Paul. Stay with us, folks. We're going to be right back with a program called Your Money. Paul usually has an excellent topic to share with us. Stay with us. We'll be right back. And we're back with Your Money. Excellent topic. How do you make your money last through retirement? Paul, I'm going to let you take that topic.
Thanks, Ron. Having spent decades saving for your retirement, it can feel like a major shift for retirees to spend down their hard-earned assets. Research by the Employee Benefit Research Institute found people with $500,000 or more in savings at retirement spend down less than 12% of their assets over a general 20-year period. Now, many of these retirees are reluctant to dip into their personal money for fear of running out of money due to the anticipation of increased healthcare expenses and other factors down the road. Now, if you at home, if you share these concerns about the longevity of your savings, know there are a few steps you can take to help you feel more confident. And as usual, I'm going to give you a few tips to get started. Number one, understand the arc of retirement spending. Annual expenses generally are the highest within the first few years of retirement. This is because retirees are often taking advantage of their newfound leisure time to pursue hobbies, travel, go out to dinner, and do some shopping. Spending tends to slow down with advancing age. You may find it reassuring to realize there is a good chance your lifestyle expenses in retirement could level out or even decrease with time. Point number two, plan for healthcare costs. Healthcare is consuming an increasing portion of many retirees' income. You can start preparing for these expenses today by researching your insurance and savings options and developing a strategy to cover your needs. Your options could include a combination of the following: Medicare, Medigap supplemental insurance, health savings accounts, long-term care policies, continuing health insurance through your current or former employer, and other dedicated healthcare savings. Having funds and projection in place can help you feel more prepared to handle a medical emergency or a more routine healthcare need. Number three, understand the level of risk in your portfolio. So as you turn savings into income, it's important to review your portfolio and assess your level of risk. This means ensuring you have a diversified portfolio that suits your anticipated spending and balances your needs for liquidity and growth. For example, consider having a year to several years of easily accessible investments to provide income in case of a market downturn or an unexpected financial event in your life. But at the same time, it's also important to have investments that are positioned for growth, or at the minimum to keep up with the growth of inflation. Many retirees spend decades in retirement, so plan your investment strategy with longevity in mind. Step 4, devise a sustainable withdrawal strategy. A well-crafted retirement income plan can help you to avoid running out of money and feel more confident about spending your hard-earned assets. Tally up your various sources of retirement income, which may include Social Security, annuities, retirement assets, and other investment earnings. Then decide which assets you will tap into first, and then when you will claim your Social Security benefits. Remember that at 72 years of age, you are required to take required minimum distributions from your traditional IRAs and other employer-sponsored retirement plans. So work this into your plan. And the last point, consider the tax consequences. Reducing the tax bill on retirement income is a priority for a great number of retirees. Yet, many feel understanding the tax impacts of drawing down assets is complex. If you share in these sentiments, starting the financial planning process early and seeking guidance from a tax and financial advisor can help you feel more secure about your long-term strategy.
Very good. Paul, if a viewer would like to talk to you, what is your contact information?
Yeah, definitely feel free to reach out to me directly at 708-226-3412.
Okay, very good. Paul, thank you for both the update today and this topic. This is very interesting. For Paul Munico with Ameriprise Financial, myself, Ron Jankowski with Channel 4 in Palos Heights, we wish you good investment day.